On the first Wednesday of every month, a group of people sit around a table in Washington, D.C. They review economic data. They discuss projections. They debate the state of the global economy with the kind of careful, MEASURED language that makes their meetings sound academic and remote from ordinary life. Then they vote on a number, a single number, usually expressed as a range of 1/4 of a percentage point, something like 5.5 to 5.5%. And the moment that number is announced, the price of your mortgage changes, the value of your pension moves, the exchange rate of currencies on the other side of the world shifts. Governments in countries that were not represented in that room recalibrate their entire economic policy. One number, one committee. Every economy on Earth moved. Most people know interest rates matter. Almost nobody understands specifically why, or how a fraction of a percentage point, decided in a single room, creates effects that reach into every corner of the global economy within weeks. Today, on Wealth Map, we are mapping the interest rate transmission mechanism, the specific chain of events that connects a committee decision in Washington to the price of groceries in Lagos, the cost of a mortgage in London, and the survival of businesses in Snow Paulo. By the end of this video, you will never read an interest rate announcement the same way again. Start with the distinction that most financial journalism never makes clearly enough. When central banks talk about the interest rate, they are referring to a very specific rate, the rate at which banks borrow from each other overnight, or the rate at which commercial banks can borrow directly from the central bank. This is not the rate on your mortgage. It is not the rate on your credit card. It is not the rate your business pays on its loans. It is the master rate, the rate from which every other rate in the economy is derived, through a chain of relationships that connects the central bank to every financial transaction in the economy. Here is how that chain works. When the Federal Reserve raises its rate, commercial banks immediately face higher costs for the money they borrow overnight. They pass those higher costs onto their customers by raising the rates they charge on loans. Mortgages become more expensive. Business loans become more expensive. Credit card interest rises. Car loans cost more. As borrowing becomes more expensive, consumers borrow less. They spend less. Demand for goods and services falls. Businesses facing lower demand reduce their investment and their hiring. Some reduce their workforce. Unemployment rises. Wages grow more slowly. Consumer spending falls further. As demand in the economy falls, the pressure on prices reduces. Inflation, which is fundamentally a measure of demand exceeding supply, begins to moderate. Prices stabilize or fall. This is the transmission mechanism, a rate decision in Washington, becoming reduced inflation in every corner of the economy through a chain of 6 or 7 distinct steps, each of which takes time, each of which is imprecise, and each of which interacts with every other in ways that even the most sophisticated economic models cannot fully predict. This imprecision is why monetary policy is simultaneously the most powerful tool in macroeconomics and the most difficult to calibrate correctly. Now here is the relationship that every investor needs to understand with absolute clarity. Interest rates and asset prices move in opposite directions, always, with mathematical precision. Here is why. Every financial asset, a stock, a bond, a property, a business, has a value that is fundamentally derived from the future cash flows it is expected to generate, discounted back to the present at a specific rate. That discount rate is directly linked to the prevailing interest rate. When interest rates are low, future cash flows are discounted at a low rate, meaning they are worth more in today's terms. Asset prices rise. When interest rates are high, future cash flows are discounted at a high rate, meaning they are worth less in today's terms. Asset prices fall. This is not a theory. It is mathematics, and it explains with almost complete precision the behavior of global asset markets over the last 2 decades. Between 2008 and 2022, central banks around the world held interest rates and are near zero for an unprecedented 14-year period. The discount rate applied to future cash flows was almost nothing. Every financial asset on Earth became more valuable: stocks, bonds, property, private equity, venture capital, cryptocurrency, all of it rising simultaneously, because the mathematical denominator that determined their value had been reduced almost to zero. When central banks raised rates sharply in 2022 and 2023 in response to inflation, the reverse happened. With equal mathematical precision, every asset class repriced downward as the discount rate rose. Trillions of dollars of paper wealth evaporated, not because the underlying businesses became less profitable, but because the mathematical relationship between interest rates and asset values worked exactly as it always does. Understanding this single relationship, the inverse mathematical connection between interest rates and asset prices, is the difference between being confused by market movements and being able to read them clearly. The zero interest rate period from 2008 to 2022 deserves particular attention because its consequences are still unfolding and will continue to shape the global economy for years. 14 years of near-zero rates produced a set of conditions that had never existed simultaneously in the modern era. Borrowing was essentially free. This encouraged risk-taking on a scale that would have been impossible at normal rates. Companies that could not generate profits that survived entirely on cheap debt and investor optimism about future profitability raised billions. Asset prices reached valuations that were only defensible if rates remained near zero indefinitely. An entire generation of investors, business leaders, and risk managers built their mental models of the financial world during a period that had never existed before and may never exist again. Their intuitions about what a normal cost of capital looks like, what a reasonable asset valuation looks like, and what a sustainable business model looks like were calibrated against conditions that were historically unprecedented. When rates returned to normal or above normal in 2022, the adjustment was not just financial, it was psychological. An entire ecosystem of businesses, investments, and strategies that had been built for a zero-rate world suddenly found itself operating in a completely different environment. The unwinding of that adjustment is not complete. It will continue to generate consequences across real estate markets, private equity valuations, government debt sustainability, and corporate balance sheets for years to come. Now consider the dimension of this story that receives the least attention in Western financial media. Emerging market economies are not just affected by interest rate decisions made in Washington. They are in many cases completely dominated by them, with almost no ability to insulate themselves from the consequences. Here is the mechanism. When the Federal Reserve raises rates, the return on dollar-denominated assets, U.S. Treasury bonds, U.S. money market funds, becomes more attractive. Global capital flows out of emerging markets toward U.S. assets. The currencies of those emerging markets weaken against the dollar. The cost of imports, typically priced in dollars, rises immediately. Inflation accelerates. Many emerging market governments and corporations have borrowed in dollars because dollar borrowing was historically cheaper than local currency borrowing. When the dollar strengthens, the real value of their debt rises in local currency terms. That was manageable at one exchange rate becomes crushing in another. The Federal Reserve makes its decisions based on conditions in the American economy. The conditions in Nigeria, Argentina, Turkey, or Sri Lanka are not in the model. They are not the mandate. They are simply the collateral consequence. Countries with the least influence over the interest rate decision bear the most disproportionate consequence of it. This asymmetry, built into the architecture of the dollar-dominated global financial system, is one of the most consistent sources of financial instability in the developing world, and it operates whether those countries are aware of it or not. The interest rate is not an economic abstraction. It is the most direct lever, connecting the decisions of a small number of unelected officials to the daily financial reality of billions of people who have never heard their names. Understanding how that level works, how the transmission mechanism operates, how asset prices respond mathematically, how the effects radiate outward through the global system, is not specialist knowledge for economists and analysts. It is the basic map of the financial world you are living in, and now you have it. This is Wealth Map, where the mechanics of global financial power become visible to anyone willing to look carefully. Subscribe, because the next map takes you inside one of the most catastrophic financial events in human history and reveals why the people who caused it were never held accountable.